All right, thank you very much for this opportunity to present my work. This is a joint work with Victor DeMigual, Li Guo, and Bo Zhang. So we know there has been an extensive literature on the informativeness of various market participants. Right? Most of the papers tend to focus on a particular group of investors, say hedge funds, mutual funds, and short sellers, etc. While some have studied the interactions between two specific groups, the interactions among these investor types can extend beyond the pairs of investors. And the form and the effect can be quite complicated, right? And also, different investors, they may be informed at different times. Even those who consistently make poor bets can reveal information about stock returns. So in this paper, we try to empirically examine the collected information reviewed from multiple investors. As I'll explain in more details later, so we consider jointly the trades and holdings of 9 market participants, like hedge funds, mutual funds, short sellers, wealth management companies, and etc. And we apply machine learning models trying to capture the nonlinearities and interactions in their relation to future returns. Just a very quick preview of our results. So as benchmarks, several univariate portfolios sorted by individual investor types do have positive alphas, do have significant alphas, but not always positive. Right. We then apply machine learning models to construct 2 sets of return predictors. One set is based on linear models, and the other is based on the nonlinear version. Right. And we find that for both the linear and the nonlinear predictors, the long-short portfolios show significant alpha. Right. And especially for the nonlinear predictors, portfolios sorted based on the nonlinear predictor shows significantly higher alpha. And the performance is robust to reasonable level of transaction costs, and it's robust after controlling for additional firm characteristics and with no sign of long-term reversal. Our analysis suggests that not a single type of investors dominate our results. And both the trades and the holdings of these investors matter. And it is important to consider the interactions between these multiple types of investors. The return predictability is stronger for firms, for smaller firms, illiquid stocks, and stocks with lower analyst coverage or higher idiosyncratic volatility, which suggests that the return predictability is stronger for stocks in more uncertain inflationary environments. And our predictors also forecast fundamentals like return on assets and ROE, cash flows, and they predict the earnings announcement returns. These return predictors tend to assign stocks on the right side of the anomalies that we typically consider. And finally, we construct a factor pricing model using our return predictor, and we show that our factor model can generate much higher Sharpe ratio than some of the prominent existing factor models. Given the interest of time, I'll skip most of the literature. Just to note that we join a fast-growing literature on machine learning and asset pricing with the pioneering work of Brian and others. The machine learning models have been applied to the cross-sectional and the time series analysis of stock returns and their relation with a large number of characteristics. Recent papers also study the performance, I'm sorry. So recent studies have also studied the performance of mutual funds using machine learning technology. Right? So in our paper, we try to show that machine learning models can actually be used to extract value-relevant information from the collective investing behavior of multiple investor types. So our data comes from a number of different sources. Our main classification of these investors are based on the approach in Jeff's paper, McLean et al.'s paper, where we identify 9 investor types. 6 of them are institutional investors, including mutual funds, hedge funds, banks, insurance companies, wealth management companies, and the rest. So the quarterly holdings of these institutional investors are from S12 and 13F filings. And we calculate the trading as the change in quarterly holdings. We use the short interest from CompuStat. Just to be consistent with the other investor types, we call the short seller holding as the level of short interest, and short seller trades as the change in short interest. Firm trade is just the quarter-end share repurchases minus share issues. We also included retail trade using tech data, and we follow the algorithm in Barber et al. 2024 JF paper, which actually improves upon the original Burmer paper to address some of the issues with identification accuracy. So we apply machine learning models, both the linear ones and the nonlinear ones. So our focus is on the nonlinear models. For comparison, we also include some of the nonlinear models, like Lasso, Ridge, ENET, and so on. And for the nonlinear models, we have the random forest, the gradient-boosted regression trees, artificial neural networks with up to 4 hidden layers. So these models have been widely used in recent machine learning papers. So for each of these models, we train them using the stock months panel data with a 5-year rolling window, right? Using the quarterly trading and 1 month lagged holding data. Right? And to follow the literature, we conduct a uniform transformation for all the predicting variables. Right? So with the trained model, and then we use the trained model to estimate the predicted return for the next month, and we just roll over. Right? So we have many models, and all of these models have their pros and cons. Instead of trying to pick a best model, we constructed 2 composite predictors. One is based on the combination of the linear model predictions. So we call them LCP, linear composite predictor, and the other is the combination of the prediction from the nonlinear models. We call them an LCP. And then we calculate the return out of sample. And then we construct equal-weighted portfolios sorted by either LCP and NLCP, and we evaluate their performance. So before we present the main results, just take a quick look at some of the univariate portfolio sorting results. So when portfolios are sorted based on traits of individual investor types, several do stand out significant. So we have, for example, hedge funds and other institutions and retail traits. Others also significant, but they have negative sign, like hedge funds, insurance companies, wealth management companies. Now, for holdings sorted portfolios, short interest stands out. So for short sellers sorted portfolios, they have a monthly high minus low alpha spread of 1.5%, which is also consistent with some of the earlier literature. Now turning into the performance of our composite return predictors. For both LCP and NLCP, we can see that for their bottom decile portfolio, they all have negative alpha for either the Farmer-French phi plus the momentum factor or the Q5 factor model. Right? And the high decile portfolio has significantly higher alpha. Right? So if we look at the high minus low spread, for LCP, the linear composite predictor, the alpha spread is about 1.78. is about 1.78%. But if we look at the high minus low spread for the nonlinear NLCP, it's significantly higher by about 90 more basis points compared to the LCP. The result holds a robust to reasonable level of transaction cost. So at a cost of 60 basis points for LCP, the alpha spread still remains at still remains high at 1.2%. And that for the NLCP is again significantly higher at 1.8%. Both LCP and NLCP continue to predict returns for longer terms. So for LCP, they continue to generate consistently high minus low alpha for up to 11 months. And for NLCP, they consistently generate alpha spread for up to 16 months with no sign of long-term reversal. Now, although we have shown that our LCP and NLCP sorted portfolios have significant alphas, the alpha could still be subsumed if there are additional firm characteristics not included in those factor models. So we next run Farmer-McBeth regression to control for additional firm characteristics such as size, book to market, momentum, the usual controls. Now here, the ILCP and INLCP are indicator variables, which takes value of 1 if a stock is in the high decile, the top decile of either LCP or NLCP sorted portfolios, and -1 if it is in the bottom decile. So we can see that both LCP and NLCP robustly predict returns even after controlling for firm characteristics. So here, for example, the marginal spread for the NLCP predictor is 1.4% per month. So that's basically double the coefficient estimated here. Now, interestingly, if we include both the LCP and NLCP in one regression, we show that the estimate of the NLCP, the nonlinear version, remains virtually unchanged, but the predictability is gone for the LCP. So which suggests that the nonlinearities and interaction do seem matter to capture the predictability to future returns. Next, we look at the relative performance between the importance between holdings versus trading. So to do this, we retrain our model using the holdings-only variables and the trading-only variables to retrain our model. And we constructed 2 separate sets of predictors, the holding-based and the trading-based. And then we rerun our Farmer-McBeth regressions. As we can see here, so individually, they remain robust in predicting future returns. But again, if we put them into one regression, again, it's the NLCP that's driving the results. So the predictability for the LCP ones are gone. Within NLCP, it seems that both the holdings and the trading matter, where the coefficient for the holdings estimate is slightly higher. So based on our estimate, roughly holdings account for about 59% of the NLCP return predictability, where the trading part accounts for about 41%. All right, so next we want to evaluate the relative importance of these predicting variables. So to do this, we calculate the Sharpe value. Right? So Sharpe is a method based on cooperative game theory. We can use the Sharpe value to evaluate, to quantify the contribution of each of these predicting variables to the overall prediction by estimating the marginal impact of each variable across all possible combinations of all the other variables. And we can calculate the Sharpe ratio for each observations, and then for each variable, we can calculate the average absolute Sharpe value, and we rank them to get a sense about the relative variable importance. Right? Now, given the computational intensity for this exercise, we only consider random forest model and for the last estimation period. Right? So overall, we see that several predicting variables stand out more important, like mutual fund holdings and trades, actually insurance companies holdings and trade, and wealth management. But none of these variables dominate the results. Right? Interestingly, earlier we showed that the short seller in the universe portfolio sorting has significant alphas, but after we consider jointly the trades and holdings of all the other investors, it seems like the short seller predictability is subsumed by the other predictors. Now, we also look at the relative importance for each individual type level and for holdings versus trading. Right? And the results is consistent with the earlier ones. Right? For example, we see again that both holdings and tradings matter with relatively equal proportion, but again, holding seems to be slightly more important than trading. Then we also want to consider the interactions between all these predicting variables. Right? So we calculate the interaction Sharpe value and rank them as we did earlier for individual variables. So the overall message is that it's important to consider the interactions between all these predicting variables. Right? So for example, we find the lagged holdings of different type of investors are important, like some of the earlier, the top ones. And also the trades of the sum of the investors, like trades of mutual funds, and the lagged holdings of others. Now, to better understand these interactions, we can actually plot the Sharpe, make the Sharpe plots. So in the paper, we make a lot of Sharpe plots, but here as illustration, we give one example about the effect of interactions between the trades of mutual fund and the holdings of the rest of the institutional investors. So here we can see that overall, there is a negative relation between mutual funds trade and future stock returns. But the effect seems to be more stronger for those stocks that has been heavily held by other institutions in the previous quarter, which are represented by these red dots. So if we look at the blue dots, it seems like the effect is much flatter. So this suggests that the nonlinearity and the interactions can be quite complicated. So we do want to apply methods like the machine learning, trying to capture some of these complicated interaction effects. Right, so we also want to see what kind of, exactly what are these return predictors are predicting. We know that from past literature, the expected returns are related to information environments. Right? So if our predictor contain information that are not embedded in the current stock prices, then we would expect this kind of predictability to be stronger for firms with greater uncertainty. Right? So to the extent that the firm size proxy for information uncertainty, we do see a negative effect of size on the return predictability. So here we see that although the high minus low portfolio for both the LCP and the NLCP remains significant for most of the size cells, but they do become smaller as the firm becomes bigger. Right? And the effect is especially strong for NLCP. So for NLCP, we see the return is very high for small stocks, but much lower for large stocks, which suggests that, again, these nonlinearities and their interactions matter more for smaller, small or medium stocks. And we repeat the Farmer-Mapex regression by including the size interaction, and the results are consistent with earlier portfolio sorting. So basically, there is a negative size effect. But even after we control for the size interaction, we still find an LCP dominates LCP. Then we further split our samples based on other proxies for information uncertainty, and we find the NLCP spread is also higher for high idiosyncratic volatilities, for stocks with high liquid, for more illiquid stocks with lower analyst coverage and greater disagreement. The only exception is firm H, where we don't find much difference. And NLCP, our composite return predictors, can also predict from fundamentals like cash flows, and ROEs, and ROAs. They also forecast the earnings announcement return. Right? And the economic magnitude seems sensible. So the spread in, So the spread in the expected cash flow ratio is about 1.9%. For ROE is about 1.55. And the spread in the earnings announcement return is about 1.56% per month. So next, we want to examine some of the asset application implications, asset pricing implications. The prior literature has examined the trades of various market participants, how they trade on market anomalies with mixed evidence. Right. We follow Green et al. And consider 102 anomalies, and we pick 12 with significant alphas in our sample period. So then we calculate the anomaly values for our LCP and NLCP sorted portfolios. Right? And we also later construct a factor model based on these NLCP and LCP portfolios. Right, so let's first take a look at the stock anomalies. Right. So it seems like our composite predictor, NLCP, does tend to assign stocks on the right side of the anomalies. So among the 12 anomalies that we consider here, we see the spread for high minus low. So the number here are the anomaly characteristic values, right? So the high minus low is significantly positive for 10 out of the 12 anomalies in our sample, right? Market cap, book to market, gross margin, and so on. With only 2 exceptions, the analyst coverage and the short-term 1-month reversal. Right, so overall, it seems like the NLCP are able to assign stocks on the right side of the anomaly. So lastly, we try to examine a factor model based on our return predictors. Right? So here we construct 2 factor models. One is LCP plus the market factor, and the other one is NLCP plus the market factor. All right. So for the LP here, this is basically the high minus low long short portfolio for LCP sorted portfolios, and this is the NLCP version. Right. So then we try to see if these models, together with the existing factor models, are able to price the 12 anomalies that we picked in our sample. Right. And we examine the average alpha and the average t-value. So it seems like our models, if we just focus on NLCP, has the average alpha about 50 basis points per month, which is kind of comparable with the existing factors. And we thought this is kind of remarkable because the factors that we constructed does not include any, at least does not explicitly consider any firm characteristics, not like the other factor models. Barillas and Shankin, 2018, argue that a good factor model should price not only the test assets, but also the factors in the other factor models. So it is suffice to compare models with the Sharpe ratios that they can generate. So we generate the Sharpe ratio for our models as well as the other existing models. And we are able to generate a Sharpe ratio, annualized Sharpe ratio of 3, which is significantly higher than the ones generated by the other factors. So it seems like our factor model based on the NLCP predictor does contain some unique asset pricing information that hasn't been included in the existing prominent factor models. All right. How much time do I have?
5 minutes.
I have 5 minutes. Oh. All right. So I guess I can have a slightly longer recap. So this is what we have been doing in this paper, basically, right? So we formed this long-short portfolio based on the nonlinear return predictor NLCP, and we showed that the predictor can generate an alpha spread of 2.5%, more than that, in fact. And the effect is stronger for smaller firms and firms with higher illiquidity, lower analyst coverage, and higher analyst agreement. All of these are consistent with the return predictability, stronger for stocks in a more with higher uncertain information environment. Our variable importance analysis suggests that both the trades and the holdings matter for the return predictability, and it is important to consider the nonlinear interactions among all these predictive variables so that machine learning models are important in this area. And our return predictor does predict the firm fundamentals, so it's unlikely that the return predictability is entirely driven by things like price impact or irrational behaviors. And we showed that our return predictability can assign stocks on the right side of the anomalies, and they seem to be able to generate higher Sharpe ratios with our factors compared to existing models. So overall, we find that combining the trades and holdings of multiple investors and accounting for the nonlinearities and the interactions using advanced machine learning models are important in extracting information for price discovery. Thank you very much.